Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today I want to talk about how your small business can save money with some commonly missed tax deductions. To be tax deductible, an expense must be both ordinary and necessary. Ordinary expenses are those typically incurred by other businesses in your same industry. For example, meal and travel expenses are common for interstate truckers, but might be less common for someone operating a local bar. Necessary expenses are those the business must incur to achieve its goal of earning a profit. Taxpayers should be careful to document in a log the business purpose for their use of a personal vehicle, meals and entertainment activities, or other expenses the IRS might want to claim are of a personal nature. Although expenses cannot be of an extravagant nature in order to be deductible, that does not mean that you always must choose the cheapest option either. Some of the most commonly overlooked deductions include sponsorships, health insurance premiums, contributions to retirement plans, educational expenses and seminars, meals while traveling, traveling expenses, and small business gifts. The deductions I'm going to discuss in detail in this video include personal interest, vehicle costs, cell phones and internet, and home office expenses. Most taxpayers already know that business owners can deduct interest paid on business loans and business credit cards. But did you know that you can also deduct interest on personal credit cards and personal loans, such as a second mortgage or home equity loan, if the proceeds of the loan are used for business purposes? For example, if 60% of the charges on your personal credit card bill are for business supplies, you could deduct 60% of the interest on the credit card. A deduction is available for the use of a vehicle, whether you own it or lease it, although there are many limitations. Taxpayers can elect, in the first year that the vehicle is put in service in the business, whether to use the actual method or the standard mileage method. Business owners who use more than 5 vehicles in the business must use the actual method, which requires good record keeping, since you must itemize out the total gas, oil, maintenance, repairs, tires, depreciation, registration, and insurance costs for each vehicle separately. You're required to keep a mileage log documenting the business trips and the total personal versus business mileage for the year, regardless of which method you choose. Personal cell phones and internet fees in the home are typically non-deductible expenses. However, taxpayers who primarily use their cell phones for business purposes can deduct the business portion. For example, if you use your phone 80% for work, you could deduct 80% of your cell phone bill for the year. Similarly, if 75% of the time you're online is business related, you could deduct 75% of your home internet bill, regardless of whether you qualify for a home office deduction. Although the rules can be complex and somewhat strict, to qualify for the home office deduction, the tax savings can be huge for those who qualify. The savings come from deducting what would otherwise be personal expenses, such as utilities like electric and gas, but also things like trash and water and sewer, mortgage interest and property taxes, homeowners insurance, and repairs and maintenance, or rent if you don't own the home. It's even possible to depreciate the purchase price of your house. The IRS now allows a safe harbor method, which gives you a flat $5 per square foot and which allows you to deduct your mortgage interest and property taxes in full on Schedule A if you otherwise qualify. At AA Accounting, our tax experts keep up to date on the almost constant changes to the tax code so you don't have to. Call us today to schedule an appointment to discuss your tax situation. We can help.